Good morning, everybody, and welcome to See the Futures. We have a great show lined up for you. My name is Jim Cagnina with NinjaTrader. Appreciate everybody being here with us today. Before we go too far, I do want to remind everybody, trading futures, options on futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I could afford to lose, doesn't change my lifestyle, doesn't lengthen my retirement horizon, and doesn't overly stress me out. Stress is a big deal in life. As human beings, we make bad decisions when we're under stress. So be in a good spot. Easy on the day trade margins. Don't max out on those. You'll get plenty of leverage as it is trading futures without extreme day trade margins. Micros are friends. They're your friends. Micros are friends. Remember that going forward. Trading, we probably won't put a trade idea in today, but trading on a real-time simulated live NinjaTrader trading platform today. None of this should be construed as trade or investment advice. All right, we are back today. We have the one and only Bobby Iaccino with us, Futures Path Podcast, Path Trading Partners, CME Trading Edge, freaking contributor to TV, and all around interesting guy. Bobby, thanks for being here.
That's too much to list. I got to quit some jobs.
No, keep it rolling while you can. I love it. And I've been listening to the Futures Ed podcast, by the way, and I used a quote from Bianco. I tuned into Bianco because of that. And I saw him on Bloomberg TV today saying, the inflation peak is the new transitory inflation. Is the new transitory inflation. So he's
not inflation yet. I thought that was a great quote. We're getting accused of being a purely Italian podcast lately. We've got Kenny Polcari coming up this week, CNBC contributor, but him and I have had some run-ins, so I'm not sure how this is going to go.
No. Well, we won't get any run-ins here. I was thinking about the topic today, and we're in the midst of really the driving season for summer vacations and all that stuff's in full effect. We've had gasoline prices at the pump a little bit better off than we were a few weeks ago. The overall energy picture is very complicated, so I thought let's talk about this stuff.
Yeah, it really is. And I think it confuses a lot of people. It's actually the thing I trade the most, the energy sector. In terms of volume in futures, it would be the thing that I trade individually the most. And it's basically because it's a simple supply and demand equation. You might say it's the same thing for ags, and I would agree, but I'm not a weatherman and I'm bad at that. And energy goes into ags as well because of fertilizer, right? Fertilizer costs involve natural gas and to a certain degree crude oil as well. Transport of ags involves crude oil. Transport of goods involves crude oil and diesel fuel in terms of the trucks, which we have the ULSD contract at the CME. So overall, energy touches everything. But then when you're looking at energy specifically, it's supply and demand and almost nothing else. The exception would be nat gas with weather. So I really like looking at these contracts because you're just talking about how much is out there and how much do people want to buy it.
Yeah, and there's several of these in this particular asset class. There's several markets that are tradable. They're good to trade. On my screen right now, I have RBOB, which is the gasoline futures. We have crude oil, which is the WTI benchmark here in the U.S. I have nat gas up here as well. And just to complete the picture, I do have the NASDAQ down here on the lower right hand side to keep an eye on that stock index future. But these markets are good. They're tradable. The technical analysis on them could be performed in really an accurate way, I think.
Yeah, and I'll give you an example. If you can change the RBOB to the weekly chart, I know that's fairly easy to do on Ninja's platform. Just hit that drop-down arrow. Look how easy that is. So you go to the 1 week, and when you look at the RBOB 1 week, you basically have a pretty solid downtrend. We've got 5 weeks of lower closes. And then we basically got the 2 weeks of recovery from that. But overall, 5 green candles, 5 red candles, 2 green candles. This is pretty much a longer term downtrend. And we got through, which a lot of people, including myself, would call that support at right around 365, 361.50. I'm sorry, up in that sort of weekly open close area from March 7th, right? Which would be just off to the left there. So when you look at that, we got through that area, pretty substantially, and we closed below it. So now an easy thing to look at is this week, are we going to rise and close above it? Is that a head fake? Even though head fakes generally up and down in basketball, we look at it as in both directions in the futures market. So we get above there and close above there. Some people might consider that the move down last week is the head fake and that we're going to go back up in here. But you look at that quote that you have on the screen there. Less gasoline has been consumed in the United States during the second quarter of July 2020 and early July than during the same period in 2021. That's from the EIA. Now, interesting part about that quote is people may forget, because it seems like a long time ago, but the entire US was not open yet last year. Okay, there were still mask mandates in places like New York City and San Francisco. Places like Florida and the sort of southeastern states, which be vacation destinations for a lot of people in the central states and possibly even on the East Coast, were pretty much fully open. But the vast majority of the US still had mandates in place in some way, shape, or form. So that's actually a very dramatic quote, is that people have pulled back on gasoline usage, obviously because of the price. And this is what I mean by supply and demand. If you look at the down move in price here on a weekly basis, it's reflected in the price. People bought less gasoline and the price started to fall. It's interesting to note that prices actually fell faster than they rose in gasoline. And that's not something we usually see. The average drop per day since gasoline has been falling, it's been about 2.6 cents a gallon. The average rise was about 2.23. Now, you're not going to notice that. Normally, it's a very weird situation. Normally, so gasoline stations buy their refined gasoline in bulk, generally covers about a 2 to 3 week period. And because crude oil specifically, and we can look at that chart when you're ready, crude oil specifically popped and fell so quickly that they weren't actually locked into higher prices. We got up to that, what is that, 130.40 high that happened, I think it was in like April. That high, I think, is 130.40. Am I right on that?
I'm looking at a weekly crude oil chart. The high I got this March 7th, high is approximately 121.
Okay, so that's not the front month at that time. On the continuing chart, it was somewhere above 130. But look how quickly we dropped. So the gas stations weren't locked in to these high price buys for weeks at a time. So RBOB actually fell more precipitously than crude oil actually did. Now, if we switch this one to a weekly, you'll see, if you remember, just kind of keep in your mind's eye that our RBOB weekly would just kind of have that rally and fall. You look at the crude week. Oh, sorry, I got a little cold. That wasn't puberty. That's a cold.
No, that's okay. That's okay. I have the same one. There we go.
We have a really well-formed, technically correct double top on crude oil. Okay. By the way, at Path Trading Partners, we have a way of looking at doubles. We did about 25 years of research and we have criterion for those doubles. I'm happy to go through them for you guys if you want, but if you look at that double top, that's on a weekly basis. So if we get a close, what I measure as the April 4th weekly low, which is about 93.81 or so, that would be what I consider the base of this particular double top. If we get a weekly close below that, just I think it'd be a little bit to your left there, Jim, it'd be somewhere around April 4th or so. Okay. We get a weekly close below that low. Okay. That triggers a move down to about 64.50 on a measured move target. Now, can I put out percentages? These are represented as my research, right? Not as NinjaTraders, Jim?
100%. Yeah.
Okay. So the percentage probability of a double top, just your run of the mill double top, is about 52, 53%. Okay. The probability that's going to hit its measured move target. Our what we call adjusted doubles. Okay. We're very strict about the pattern and the shape and the way it's supposed to work out. We've hit about 64, 65% in those targets being correct. Now, if you keep your risk to reward below 1-to-1, so reward being 1, risk being 0.99, 0.98, whatever, you will, it's almost I don't want to say this. It's hard to lose money. Okay. Over time, over an extended period of time, it's hard to lose money.
This is when I throw in past performance, not indicative of future results.
It isn't. So the interesting thing about that, so I just threw out a 65% number, right?
Yeah.
That means that 35% of the time you could be wrong. That means that in 100 trades, you could be wrong 35 in a row, which hurts. A lot of people can't survive that. That's why what Jim said about leverage at the intro of the show is so critically important, right?
Yeah.
And not over leveraging and not saying, wow, this is a really good double, so I'm going to put more money in it. No, you have the same amount of risk the way that we do things, same amount of risk for every trade, no matter how excited about it we are. So anyway, if we get a weekly close below that low, which I have marked here at about 92.93, I could be off a little bit, but if we get a weekly close below 92.93, so that means Friday's close, there's a longer medium to long-term target on crude oil of about $64.
Wow. So, I usually do this on a 10-minute chart, but I like to put rectangles up there. And I like to think in terms of support and resistance isn't a number in my mind. It's a range, right? We're volatile. Right. The prices move around. So when I look at this chart just off the top of my head, I'm going to throw a rectangle up above here at the top. I see this turnaround doji that happened right here on June 10th, which was kind of telling. And then I drew another one. And this is kind of telling me, hey, there is some long-term area of support right here where my rectangle is, and all the way back to March 18th. I know we're looking at weeklies, which is not my game, but that's kind of how I look at this. It's close to the numbers that you're talking about.
Yeah. So in terms of like the technical correctness of this particular pattern, the weekly close below, I need to look here again to make sure I have the right level. I don't want to keep saying this level and have it wrong. The weekly low on this it's 93.81. No, I'm sorry. Correction on that. 92.93. So that exact level, if we get a weekly close below that, we consider that to be a triggered double top. Now, that doesn't mean you have to enter there, right? On a lot of these things, like Jim said, a lot of people who trade on vanilla support and resistance, they'll go, okay, we hit the buy level, so I'm going to buy a little bit. So you can get a little bit of pressure going back up. But that target's a medium-term goal of that $64 range. And the reason I'm talking about this so much is I want people to watch this over the coming weeks. We're going to be with NinjaTrader for a while now, and I want you guys to call me out if this was wrong. And if it is wrong, by the way, I never consider a trade to be wrong. I consider that a good trader takes all the trades that his or her process dictates, and therefore none of them, you weren't wrong in taking any of those. Where you're wrong is covering winners too quickly, which would be against your process. You're wrong if you move your stop, if that's against your process. So if you have a process that's set in stone, that's written in your trade plan, and your process says, my stop on this one's going to be $110, okay? And then you go, I'm getting scared. I'm going to tighten my stop up, and you get taken out too early. Or it's running to my stop so quickly, I'm going to give it more room. That's when you're wrong. Losing trades are not wrong. Losing trades are the complementary probability to winning trades. You can't have one exist without the other. And nobody is 100%. Hell, nobody's 95%. Right?
I agree with you. And we preach that every single morning. Come up with your plan, stick with your plan. Don't be calling audibles in the middle because your FOMO kicks in or whatever other demons are going on in your head. Just stick with your plan. You're going to have losers all the time. But going back to the supply and demand question, on crude oil. Now we have inventory reports coming out. And how important is the Energy Information Administration's weekly inventory report number?
I'm so happy you brought that up. My favorite thing. So the EIA report, if you could switch this back to a daily, the thing that comes out in the EIA report that I look at the most is the refinery utilization. Okay, because right now, there's plenty of crude oil out there. All right. Even though there's a lot of talk about undersupply and, President Biden trying to get OPEC to produce more, which, by the way, you see that low there on the crude oil chart, that recent low, that was the Biden trip. Okay. So there was an idea that he was going to get somewhere with OPEC. And I'm not saying he did or didn't. I'm just saying as of right now, the chart and the price action is showing you there's no indication of OPEC upping production, and they've been silent on the issue. Okay. So EIA puts out the refinery utilization number, and you can view the history going all the way back to 1985. Okay. It's on the EIA's website. It's very easy to find. Over the last few weeks, refinery utilization has been above 90. Okay. So what is refinery utilization? It's the amount of possible capacity that a refinery can put out that's being utilized. So if it's 91%, that means 91% of available operable capacity to produce gasoline, diesel fuel, jet fuel, tar, plastic, the base for plastics, everything that crude oil is used for comes out of a refinery in some way, shape, or form. Right, the last one was 89.6. Okay, now this reflects, by the way, that was an April number. The EIA's had some problems lately in putting out their data, but the last one that the EIA.gov website has listed was 89.6. That reflects the statement that Jim put up about gasoline not being used as much as it was of July last year, because the refineries are not pumping out as much. Maximum capacity in my years of experience is about 95. Okay. Why isn't it 100? We've actually gone to 100. We've actually gone to 101. There was a period of time back some years ago where a refinery tried out a new temporary refinery process. That thing blew up. It was an awful experiment. But for a while, we were at about 101 capacity for a couple of weeks. I don't mean physically blew up. It's just the whole project blew up. But if we get to 95, that means refineries are pumping basically full out. So why is it not 100? Because there's always parts of the refinery that is under maintenance, a gear breaks, a pipe springs a leak. So there's always parts of refinery that are being worked on in some way, shape, or form. If we get to 95, 95.1, they're pumping full out. There's not much else that's going to happen. And when you see that, you generally get a price bump in RBOB and you get a price fall in crude. And it's because the crude oil's there, but they can't sell it to anybody. So they have to sell it to go in storage. And if somebody has to pay to store it, they want to pay a lower price on the actual barrel.
Yeah, that makes sense. So there's what you're saying is, though, potentially there's a 6% gap still here on the upside. And in my mind, I'm going to ask the follow-up question: is the ratio between regular gasoline and diesel back to normal, or is that still out of whack a little bit?
It's still a little bit out of whack. And that's because the demand curve, if you look at like how much crude has fallen and how much diesel has fallen, crude fell a lot more. And that again is because the buildup of crude came from the sort of shortage of gasoline, right? So the refineries were pumping out more diesel because that's the fuel of economic growth, right? That's the fuel of products being shipped back and forth, right? A lot of trains use diesel. Most trucks use diesel. So they had to keep sort of the engine of commerce going, and they were pumping out more diesel. It's still out of whack a little bit. So diesel didn't actually fall as much as crude oil did because diesel fuel wasn't being stockpiled. It was being used. So it's interesting when you look at refinery utilization versus what's going on in the actual market, you can see what the refineries are doing if they were at 95 during that period of time, it probably meant that they were still in whack. But we were going into the summer driving season. We weren't there yet, and gasoline demand had kind of slowly fallen a little bit going into July.
Yeah, it makes sense. From my just casual eyeball around the South here, people are going on vacation, going to the beach, driving all over the place. Roads are kind of crowded. Maybe it's just a regional thing down here, but people are on the move this summer.
Well, there's one thing I want to point out in that sort of relationship we just talked about. So obviously everybody looks at whether there was a draw or a build on the EIA data and how that worked against the estimates of a draw or a build. But I will tell you with a high degree of certainty, the initial move on a draw or a build is wrong if refinery utilization doesn't match it. Okay, because sometimes you get a build in crude oil, and then you see the refineries are operating full out, and that build is because the refinery couldn't take the crude in, rather than overall rather than overall demand being depressed. It could be that demand is there, but the refineries are pumping full out, and the crude oil companies are like, "You want a couple more barrels?" And they're like, "Where am I supposed to put this stuff? Where do you want me to put it?" So the crude oil
Right.
company has to store it and lower the price.
So there's a bottleneck basically
Yes.
in the
And refinery
manufacturing
utilization
process.
tells you oftentimes when there's a bottleneck when you compare it to whether there's a build or a draw.
Got it. Okay, that's great information, and that's a nuance that most people won't think about going into making their trade decisions for sure. Because that number hits at 10:30, and on a daily chart, a lot of our focus is on day trades. On a daily chart, you get some crazy looking candles at 10:30 on an intraday chart because nobody knows how to assimilate the data, right? It's all over the place, and it takes 10 minutes, 15 minutes for a candle to settle down and to get equilibrium based on the answer.
Can I go rogue here for a second, Jim? Is that allowed?
Yeah, it is. It's encouraged.
If you could put up the 4 charts again,
yeah,
and turn one of the other charts to a crude oil, say 15-minute or 10-minute, maybe the RBOB chart since it's right next to it.
Yeah, we can do that.
You could make that like a short-term crude oil chart, whatever you want, 10-minute, 15-minute, I don't care.
I'm a 10-minute guy. I'm putting it at 10.
All right. So if you compress, okay, you compressed it. If you could give me sort of a visual marker of where today started.
So, well, what do you mean by today?
Where was the open today approximately? And it's fine if it's overnight. Whatever the daily chart marks as the open, if you could sort of give me that time on the 10-minute.
Well, I always like to track it all the way back to the actual, the Globex start, which is 6 o'clock, which is way up here.
What do you want to do? I just want to make a point here.
Okay.
Because I don't actually know this about you, but I'm going to go out on a limb and say you're mostly price action based. And that is absolutely the smartest way to be. Okay, because what you're seeing on the 10-minute chart as well as on the daily chart is the only thing that can be verifiably true. I just gave you my opinion of my research done on draws and builds and refinery utilization. Okay, I'm also humble enough to know I could be very wrong about all this. In my experience, it hasn't shown that I'm wrong, but there are times when your fundamental opinion doesn't match what is true, but yet the trade works anyway. And I can tell a story about that if you want. If you look at the start of the day, look how crazy the 10-minute candle, the 10-minute chart looks, right?
Yeah.
It's up, down, big wicks, huge green candles, huge red candles, right? Just look at all this movement. Now look at the daily. If someone looks at the daily and go, crude's not doing anything, huh? If you look at just today, that crude's not very active today, right? Look how small the candle is. But then look at the craziness, the absolute craziness in the 10-minute chart. This goes to don't screw around with your levels and your plan and all that, because we call this candlestick math. And what candlestick math is you take the craziness of the short-term charts and you compress them and you see how crazy the day actually was versus what a normal day is, right? So you look at today's daily crude oil chart, and it's very small compared to 2 days ago. Like you would look at the daily and go, crude's been quiet.
Yeah. No, for
10-minute, crude hasn't been quiet at all. And it's very important for you to kind of put that into your head and you go, oh my God, things are nuts today. And if I'm looking at the daily, I'm like, what are you talking about? It's very calm.
Well, let me ask you this question on that note. I agree with you 100%, right? These daily candles, they could be, 6, 7, 8%, right? They're huge. Sometimes they're small, like today. But when I call these things icicle candles on the icicle wicks on the bottom. Yeah. I don't know. I'm going to try to trademark that, but these are icicle wicks. And when I see this behavior in front of a number, in my mind, and tell me if I'm wrong, I could be wrong here. I feel like traders are anticipating a negative number, right? They keep trying to push it down. These wicks are big at the bottom. And in my mind, that's more anticipatory in front of a number. I could be totally wrong, but they're wicked. Look at how big they are.
You couldn't be more right. So we call these emotional candles. We call the big filled candles emotional candles, and the ones with long wicks, we call them emotional wick candles. These are emotional moves when you see it. The rest of the moves are very controlled. So for example, if you go to the left, that's sort of on the 10-minute chart, and you see that sort of consistent down move, it's like almost all the way to the left. It's likely that move right there. That was likely somebody hedging. Okay, there's no emotion in hedging. All right, it's like, and I used to work at a company that physically bought barges of oil. And that's why I know weird stuff like crude oil flows at 11 to 14 miles an hour through a pipe. And if you speed it up, it damages the viscosity of the crude oil. That's why I know these weird things. By the way, that was my worst period of trading crude oil ever, is when I worked at the company. Because you hear all this stuff about, there's Somali pirates attacking a ship, and you go long and it doesn't really matter, right? Because the ship is insured and it doesn't impede the flow of crude oil. Anyway, what you're seeing right now, you're seeing them trying to push it down. And then you see the long wick. It's like, okay, people are scared that I'm not right. I'm going to cover this. Okay, now they're trying to push it down again. Oh, crap, the number's out. I'm wrong. I'm not covering this. And then you see the long wick at the top of the current candle that we're in on the 10-minute chart. And it's like, maybe refinery utilization doesn't match I don't even see if this was a build or a draw, but I'm assuming it was a draw. And you look at this and say, oh, wait, maybe refinery utilization doesn't match. So now they're selling it off a little bit. Wait, it's going up again. All this stuff. If you are not following your process, I suggest to anyone who has the kind of courage to do it, is you put your trade in, you put your stop in, you turn your screen off, and you do some push-ups. First of all, you get in better shape. Second of all, that nervous energy gets out. And third of all, just turn the screen on later and see what happened. You weren't right or wrong. You were right because you followed your process.
Yeah, I agree. And I also suggest, hey, just don't get in front of a release. Just be patient. And then depending on your account size, remember, I said it in the introduction, micros are friends, because micros gives you the ability to maybe put your stop a little further away to let you survive some of this volatility.
So it's funny, I traded a lot more short-term prior to the micros. And it was interesting. I left the trading floor in 2004. Okay, I was still making good trading floor money. But to me, it was like, I don't know how long this is going to last. I need to learn something else. So I actually went upstairs. That didn't work because I found myself continuing going down to the floor and putting in a couple of trades. So I moved to California to make sure that I couldn't do that.
Yeah.
And then I moved back. California's awful. No offense to anybody that lives there.
Oh my goodness.
But
oh my goodness.
That was more of a tax thing for me than anything else. It's the most beautiful place on earth, but whatever. Anyway, so I moved back, but I had learned that as I expanded my price bands and shrunk my position size, I could be a lot more calm. Now, this applies to the short-term day traders as well. Okay. If you find yourself stressed out about your trade as all of what you're seeing on the screen is happening, you need to shrink your position size or shrink it even more and go out to a longer time frame. Because if you look at, I turned negative on crude oil about June 28th, and I've engaged in 2 short trades since then, and both of them have made money. I've had no trade on since then. Okay. Now, what you're seeing on the daily chart is my main chart, and then I'll go down to the 4-hour and the 60-minute to try and fine tune entries. So the importance of the chart goes from higher time frame to lower time frame. And by the way, that starts at your highest time frame. It's not a judgment that you should trade the way I trade. So if your highest time frame is the 10-minute, it's much more important than the 5-minute or the 1-minute. And the reason is because the most important piece of price action, in my opinion, that a chart is showing you is the closing price of any time frame. So the closing price of this 10-minute chart is where the market believed crude oil's fair value was after a 10-minute time period. So that becomes the most important piece of data. Who cares about that low right now? Like, seriously, right now, who cares about that low? Nobody does. So from my perspective, I'll look at the dailies, and the daily has gone from basically negative to negative neutral to me right now. And it has a lot to do with the rotation zones that we've talked about before. The rotation zone for me is an 8-minute exponential moving average, and it's an 8-period exponential moving average and a 21-period exponential moving average. So just for S's and giggles, look back over the 10-minute chart, which still has those same exponentials on it, right? Yeah. Now look at how many times the market goes into those areas and then fails from it. Now, because this is a 10-minute chart, you have fewer 8 periods and fewer 21 periods than you do on a daily, right? Because when you move from one chart to the other, I said 8 period for a specific reason, right? So this is 8 10-minute periods and 21 10-minute periods. So on a 10-minute chart, if I were going to trade the rotation zone, I would look for a very steep downslope Maybe if you could justify that trade to older price action a little bit. I'm sorry, the chart.
Yeah.
See that very steep rotation zone that's off to the left right there? Well, the 28th is about when I turn negative, right? So now you could literally trade the rotation zone because it's steep and it's separating and getting wider.
Yeah, right.
Now, as it starts to turn and flatten out, it becomes a lot less reliable, right? Well, the same thing happens on the daily chart. Right now, I wouldn't even say that it's turned up. The 8 is turned up, but the 21 is flattened out. So to me,
the 8 is the
flattening.
Go ahead.
Yeah, the 8's turned up and the 21 is flattened. So that's a tightening and a flattening of the rotation zone. So it is no longer a playable rotation zone to me.
Nice. So I'm going to tell Mission Control right now, we're going a little over because I have another, and we're going to do this quickly. We talked about it earlier. What do you think about the relationship of the US dollar being as strong as it is with respect to energy pricing?
I told you got to cut me off, Jim. I ramble. I'm sorry. In terms of the dollar and commodities, what you're looking at with the dollar and commodities is that everything globally is priced in dollars. Okay. So when the dollar gets stronger, crude oil, copper, gold, aluminum, all of that stuff becomes more expensive on the global market. Therefore, the demand falls. So it's very much what the Fed is trying to do with inflation right now. They're trying to raise the cost of borrowing so demand falls for things that you would take loans out on. So it's the same thing. When the dollar rises, global commodities become more expensive. So there's less demand because countries like Sri Lanka and Thailand and Vietnam can't afford to buy as much. So they wait or they go off their stockpiles. So it's really simple. Dollar higher, commodities lower, all else equal. Okay?
Excellent.
If the dollar is higher and copper price is falling because a new mine was developed and they're about to produce triple the copper that was being produced before, the dollar thing doesn't matter. So, but all else equal, dollar up, commodities lower. That's the relationship.
Awesome. Excellent. I appreciate that. There's so much stuff we could talk about. We didn't even really get into liquefied natural gas. We'll save that from another event. I do want everybody to know how to find you in general. I mean, the podcast's awesome, by the way. I've been listening to it. It's weekly, right?
Yeah, it's weekly. We're having a lot of fun doing it. We're getting massive name guests like Jim Bianco, John Najarian, Cameron Dawson. We have Peter Bookvar coming up, and this week we've got Kenny Polcari. Anyway, you can find that on Spotify under the Future's Edge podcast, and it's the free version of Spotify. So don't worry about having to get a Spotify subscription. It's also on the Path Trading Partners YouTube channel, which we do live webinars 2 or 3 times a day on that channel. That's also free. We're not trying to sell you anything. So you can subscribe to that and the podcast gets dropped there as well. You can also reach out to me on Twitter. My DMs are always open. Bob_Iaccino is my handle on Twitter.
Awesome. I encourage everybody to follow. I am learning a lot just following Bob. I appreciate your time today. We had some questions and comments from folks that were really, really keen and insightful, but our time is so tight. Couldn't get to them.
I apologize for that. You literally got to shut me up.
No, that's okay. And I'll try to pick off some of them myself at our bar's closing event later on this afternoon. So again, thank you so much for being with us. I can't wait till next week.
All right. Good to talk to you guys.
All right, everybody. Thanks for coming. Appreciate everybody's participation. Appreciate everybody coming today. Remember, please be safe out there and be good to each other. Thank you.